Hey folks, welcome back to the channel. Just I had to rearrange my desk today. Want to make sure the microphone is working. Let me know if you guys can hear me. Wanted to start off by putting this graphic up on the screen right away so I can talk to you in a way that the mainstream financial media is not going to, because they're driven by emotions. We're going to talk in a calm and rational manner about what's going on in the market right now. We're going to talk a little bit about market capitulation, and about why market capitulation might look a little bit different than it has in the past because of the way money is flowing these days. And we're going to talk about the improving supply chain conditions that are going on out there. For anyone out there who's calling a bottom, like I'm saying, it's going to be around 3,600 or so. But for anyone that's calling a bottom out there, saying we're near market capitulation, let's really take a look at the options for those who are capitulating. For those who are just saying, if you don't know what market capitulation is, it's basically the point where the retail investor gets out. They just say, man, my losses are so bad, it's time for me to get out of the market. And boom, that is the end of that market cycle. Usually in the beginning of a new bull market, it usually starts off pretty tame and then kind of builds over time. So you get a lot of gains in the market without the general public kind of realizing the market is going up. This happened to a great degree in 2009, right? The market was up like 57% before the economy stopped shrinking, right? So that was like March 9th, 2009, all the way actually to January 10th, 2010. The market was up 57%. And yet in all of those quarters in between, the government still reported that GDP was shrinking. So let's talk about why I never get too concerned or too excited when the market goes up, or especially when the market goes down. I see the market going down as an opportunity. Why? Because even if you don't have a lot of patience, even just 6 months pays off most of the time. Let's talk about that. I wanted to start off this live stream with this particular graphic on the screen. This is S&P returns after the S&P falls minus 20% from a record high every time it's happened since 1950, and then what the market's doing 6 months later. Right. So going back, of course, most of you folks really aren't even old enough to remember this right here in 2008, which is one of the worst declines we've been in. And the other one that was really pretty bad was in 2001. But actually, the one that's probably most comparable to today's situation, and there are a lot of caveats to this. It's always different, guys. But this 222 1982 is the situation that's probably most comparable today. That is when the Federal Reserve raised interest rates up to 21%. Now, the Federal Reserve, in our case, will not be hitting 21% interest rates, largely because they have a bunch of other tools in their toolbox that the Federal Reserve really didn't have back then. It was Paul Volcker's idea that you could control inflation by constricting the money supply by raising interest rates, right? And Baron Romaine, I had a friend growing up with a similar name, and I wonder if that's you and you just changed it. Let me know. Um, yeah. So, and I want to talk about the UK situation as well a bit later on during the live stream, but let's get back to this graphic right here. So in every case in this first column here is the date at which the S&P 500 declined by 20% from an all-time high. And what happened 6 months later? Well, 60% of the time, a mere 6 months later, if you held the S&P 500, then you were back up. And you were up on average of 4%. Now, of course, that's widely varying because you have some years where you were still down. So 1970, that was another inflationary event. 1973, that was another inflationary event that was actually spurred by a war in the Middle East and constriction of oil supplies to the West, as OPEC plus countries decided they weren't going to sell oil to the West for a while. And then 1982 was basically the fallout from all of those periods where they decided to definitively deal with inflation and to engineer a double dip recession. So 1980, 1981, 1982, what you really had was a double dip recession. And again, we had a reemergence of recession under President Bush in 87, 88, 89, 90, 91. We kind of had a slow economy then. So it actually wasn't that bad in terms of recessions. I'm talking about the late or early 1990s, but it was made into a political event, which was more than it needed to be at the time. So 60% of the time, a mere 6 months later, the S&P 500 is going to be positive, and your average return is going to be 4%. So let's throw out the anomalous one here, 2020, because that was really like a V-shaped recovery in the market, 35%. So we're looking at the only really terrible period in the last 50 years was 2008, where we almost saw a global collapse of the economy. But in 2001, you're looking at minus 7%. In 1973, you're looking at minus 9%, and in 1970, you're looking at minus 9%, and that is 6 months after falling 20% from a record high. So 1 year later, you basically have a 70% chance, according to historical data, of being up, and on average, you're going to be up about 15%. Again, the anomalous one here is 2008, and then by here, you're almost back to even in 2000 in 312 2000 after the 312 2001 by 2002, and again in 1973. So 1973 and 1974, the market was down, I think, 22 and 25% in those 2 years. Really screwed up retirements for a lot of folks. By the time you get out to 2 years later, and I hope that most of you have the patience to be able to wait for 2 years for something. Once again, there's a 70% chance that you're up, with an average of about a 26% return in that time period. By the time you get out to 3 years, there's an 89% chance that you're up, the only exception being 2008. If you are sufficiently diversified, something with these probabilities is probably what you can expect. If you are not sufficiently diversified and you are heavily into tech stocks, the ride might be a little bumpier for you. Now, I've been pretty open about my holdings here. My wife won't let me actually post what we actually have, but roughly 70% of my investable assets go into a broadly diversified ETF portfolio with a few legacy mutual funds that I have a lot of gains in and I don't want to sell and pay taxes on. So I hold those as pieces of my portfolio as well. So, but in my undiversified portfolio, which is about the 30% of my net worth that I put into individual stocks, I'm getting hammered just along with the rest of you guys because I do tend to take a lot of risk and I have an appetite for risk. Now, that's something we should probably talk about as well. When I say that I have an appetite for risk, I have quantified what my appetite for risk is. And a lot of you folks probably have not quantified what your appetite for risk is. I would highly encourage you in this environment, especially now that we actually see a bond market that is kind of returning to normal. And it's not acting rationally right now, which is actually not a terrible thing because it provides some buying opportunities there. But I would encourage you guys to go out and to take a risk tolerance questionnaire exam that's going to give you numbers as far as how much you should put into less riskier assets and how much you should put into riskier assets. This is something that you should have done a long time ago when you first started to invest. But in these really trying times, now that you've kind of learned the lesson and gotten smacked down a little bit, you may want to dial back the risk a little bit going forward after the market recovers in order to have some downside protection. Because the psychological damage from losing money, say losing 10%, is actually a lot greater than the psychological satisfaction of seeing your account go up by 10%. And that can negatively affect your decision-making process going forward. Folks are not really rational when it comes to investing. They tend to invest and make decisions in investing based on emotions. And that's the biggest killer of portfolio performance over time, and that is your decision process. The fewer decisions you make, statistically, the more likely it is that you're going to be successful. I'm going to be making rock bottom purchases right now with companies that have either have really good current cash flows and I think are undervalued because of the panic, or I'm going to be making purchases on companies that don't have good cash flows because they're still growth companies, but they're still able to grow in this environment and they have a pathway to profitability. A lot of those are in fintech that is absolutely getting destroyed right now. I think Moneyline was down to like 80 cents because of the announcement of a lawsuit from the Consumer Finance Protection Bureau. And it's like down 20% in a day. So I ended up buying a few more shares of that today. My break even on Moneyline would be, I think, like $1.60 now. So, and doubling would not be out of the question in a year, just if simply if macro environment improves. So, yeah, let's talk a little bit about your opinions on this, if you have any. And I'm going to go through and start addressing some questions. And then I'm going to talk about some of the really important news today that likely negatively affected the market. And a lot of it had to do with what's going on in the UK. And the UK is making some contradictory moves when it comes to monetary policy that is causing a little bit of panic. So let me see here. Tell 666-999, longtime watcher or listener of my live streams. Who else has some dry powder for these times? Glad I have. Thankfully, not gloating. Personally, waiting for AI day just to see how far they have progressed. So, when it comes to Tesla stock and AI day, I have actually sold some calls on Tesla, way out of the money calls. Like, especially now, they are way out of the money calls to generate some extra income. Normally, I do that. Um, uh, anyway, a little bit. I do that a little bit on my position. So every 2 weeks, 3 weeks or so, I'm rolling an option on there to generate some income. In this case, though, because I don't see a lot of positive, even with AI day, because of macroeconomic conditions, I think that the bump with Tesla is going to be pretty short term. So I've sold some options out there a little bit closer to the money, nothing crazy, in the 350 to 360 range by November, December, which generated some fairly good income. And but it also means I'm a little bit pessimistic when it comes to AI day. I don't think it's going to have the impact that maybe it should, right? It could be far, like battery day was far more important than people realized, but it's going to take a long time for all of those things to be realized. AI day, I'll evaluate that after I watch that. So, yeah, so let's talk about UK and the mini budget. We're not going to talk about the mini budget in exactly, but we're going to talk about this right now. So, central banks around the globe are keeping Wall Street up at night. And largely because there's been this giant flight to capital here to the US because other central banks across the developed world are not keeping up with us in terms of raising interest rates to combat inflation, which means that we're attracting tons of investment dollars in the form of purchases of US securities. Now, look, you could buy Turkish securities right now, long range Turkish securities right now, or 10-year Turkish securities right now, I think at 13 or 14%. Or you can buy US securities at 4%. Where do you think the money's going? The money is going to US securities at 4% because people believe in the industrial and money-making capacity of the United States. And they believe in, most importantly, in the claims paying ability and history of the United States. We've never failed to pay on our debt obligations. If the United States were to fail to pay on their debt obligations, that would end the world's economic system as we know it today. And then we would truly emerge into a multipolar world, right? Where the world would be forced to go out to find more stable economic pastures. So, but the US 10-year Treasury yield plummeted a little bit since the global financial crisis, while the dollar index fell most since the pandemic 2020 bear market. But the Bank of England catalyzed these moves early Wednesday morning when it intervened to prop up its flailing bond market. Now, this is positive for someone who is a United States citizen who's going out of the country, who's going to spend money as a tourist somewhere. Your dollar goes further. But a strong dollar hurts the U.S. economy in many, many ways. And it's really strange that as we're losing purchasing power in the United States due to inflation, the dollar is increasing so strongly overseas against foreign currencies. And like I said before, it's like when you go out to a bar or something at night, you're with a group of friends, you meet a group of girls, one of you's got to fall on the grenade. Well, the United States basically is the least ugly grenade. Let's put it that way. Somebody's going to get offended by that. And that's literally what it is. It's not that the United States is in such great condition right now. It's that we do have a large industrialized economy. We do have a history of claims paying abilities. It just means we're the least ugly country in the group of countries issuing debt right now. And you're the most likely one where you're going to get your money back. That's all that it means. It doesn't mean that we're special. It just means that everyone else, it's not because we're so great. It's that everyone else is so bad. Okay. So the Bank of England moved to prop up their flailing bond market largely on this right here. Pension funds were reportedly facing massive margin calls that threatened their solvency. That is a huge deal. If the Bank of England decided to step in to prop up bond markets, that is the reason why. It's because pension funds were facing massive margin calls. My question is why do pension funds have that much on margin in order that they would be facing these massive margin calls? We have rules and regulations that limit the amount of margin that pension funds can use here. I would assume that they have the same sort of regulations in the UK. We even have trigger regulations here in place that would cause pension funds to deleverage in certain cases. And I wonder what those are in the UK. I'm just not well versed enough in the higher end of UK finance law to our regulation to understand what's going on there. But the UK bond market was going towards a disorderly unwind, and it looked like the central bank had to step in. So, which is causing the pound to fall even further, which I think is interesting. It's the first time in my life, maybe not the first time in my life, but the first time that I can remember that the pound has been lower than the US dollar. So, yeah. And Demos says Jello. Oh, hold on. This is a good question. Do you think that if the Ukraine war continues into next year, the Cold War, it might be more like 1973? So I would count on the Ukraine war continuing into next year. So, I'm not going to second guess all of the military experts, even though they've all been wrong about what's happening in Ukraine. In fact, happily wrong about what's been happening in Ukraine. I'm glad that they were able to resist. But I think that I would not plan on it being over. This has all of the hallmarks of something that's going to be long and drawn out. And I don't even think that really significant battlefield victories on the part of Ukraine, kicking the Russians out of like Luhansk province and kicking them out of Kherson and Zaporizhia, and all, I don't think that would end it. I think they're just going to spin up their industrial capacity, rearm, regear, and throw more people into the meat grinder until Putin is removed from office. It's going to be a coldish winter in Europe, but based on the numbers that I'm seeing, it looks like they have, and the fact that Germany decided not to take 2 of their nuclear power plants offline, at least until May, which I bet they get extended well into next year and probably don't come offline until 2025. I bet that happens. I think that this winter may not be as cold as we originally envisioned it at the beginning of the war. Europe has done a really good job of securing and storing supplies. The fact that Nord Stream 1 and Nord Stream 2 have been sabotaged, I know that a lot of people think that the US did it. A lot of people think, or the Russians seem to think, or at least they seem to blame Poland for it. I wouldn't be surprised if Russia itself did it to give them a pretext to do something else, right? I would not be that surprised at all because they know that the move to cut Russia off from gas sales completely to Europe is coming. They know that generationally speaking, they're absolutely screwed when it comes to natural gas sales. Putin could die tomorrow, and Europe is not going to start resuming buying Russian gas at the levels they were before, and they're going to make plans to wean themselves off it as quickly as they possibly can. They're not going to allow someone else to use that as a political weapon against them. They're going to diversify their energy supplies. North Africa, Cyprus, Israel, and the United States are going to be the biggest beneficiaries of this because we're already set up to deliver natural gas. And I'm not kidding when I say Israel. They have actually pretty large natural gas fields that kind of split with Cyprus out there in the Mediterranean that have been developed over the last 20 years or so. Man, I keep getting these spam notices from Coinbase saying that my account has been suspended. But no, I don't want to say it would be more like 1973, but it could be more like 73. Yeah. So yeah, let's talk about that as well. And banks are well capitalized now with bigger buffers and stronger stress tests. Well, in the UK, that's actually true in the US as well. And it's not necessarily banks that are in trouble right now. It's investment banks that are in trouble. They're in better condition here in the United States as well. And I'm not hearing any rumors of large margin calls for pension funds or anything like that. That's a big deal. So the institutional business in the stock market makes up the vast majority of trading that goes on. It's not you and me on YouTube. It's not the millions of YouTubers out there or people watching YouTube that are driving markets. It's institutional buying and selling that drives markets. So, yeah. Let me see here. Any experience with art investing? No experience with art investing, and that's an acronym, or maybe that's not an acronym, but it's something that I'm not all that familiar with. I'd be happy to talk about that though at some point. Maybe you can contact me offline and we can talk about that. So. UK for me, and I'm sure the US, we've been used to cheap money. There was always a time we had to go cold turkey. This is a moment for the UK. So I don't like to comment on the politics of foreign democracies because it's your country and your choice. So I don't like to comment on the politics in general. But I will say one thing. It looks like your current government is going back in time to reinstitute some of the policies of Thatcherism, which didn't turn out too well for the economy of England, and ended up pretty badly affecting the power of labor to negotiate for better wages in England, or not just in England, in the UK. And that's something that I want to see. I want to see how that plays out. So, but I don't, like I said, I don't really like to comment on the politics or even economic policies. Specific economic policies of foreign democracies, though, largely because I think the United States and United States citizens who have no idea what they're talking about do enough lecturing to foreigners. Okay, I'm not going to do that. So, do you think the mysterious exploding Nord Stream pipelines is a signal of future attacks on important pipelines? Well, important pipelines have always been under attack. Nigeria is probably. So I worked. You guys know I worked in the oil and natural gas industry. I did it from a data perspective, working as a programmer. But you pay attention to a lot of things that are going on. And I did a short stint in Nigeria, which is where I got my supply of hydroxychloroquine. By the way, is when I did a short stint in Nigeria, just a few months. But even a long time ago, almost 20 years ago, when I was there, attacks on pipelines were pretty normal. Not only that, people just opening taps on pipelines and trying to walk away with gasoline was pretty normal. And occasionally there were these giant accidents. The only thing that has prevented attacks on pipelines so far has been civility to a large degree. And that is rapidly disappearing. I think that the biggest danger for NATO right now getting dragged into this war really doesn't come from like the UK, France, Germany, Belgium, Luxembourg, Denmark, Sweden, or the biggest danger really comes from Lithuania, Poland, Romania, Slovenia, Slovakia, like all of these countries that have suffered under Russian domination at one point or another, who are very much cognizant of the threat that Russia has posed for the last couple hundred years. And so I think that they are actually the biggest danger to getting us sucked into a conflict. And Russian parliament members, or Duma members rather, have already started to blame Poland for this without providing any evidence, of course. But that narrative is probably going to take off in certain circles here in U.S. media. And when I'm really talking about like social media, and there will be a lot of people that believe that, whether or not it's true. So the UK government announced plans to support citizens with energy bills. That's all we're expecting. However, the cutting of taxes for top earners was not without explanation. Yeah, so trickle-down economics, and that's what I was talking about, which was the return to Thatcherism, which trickle-down economics. Certain people, this is how I equate trickle-down economics. The upper classes are going to pee down your back and convince you that it's raining. Okay, that's what trickle-down economics is that you give tax cuts to the extremely wealthy and you get to enjoy whatever trickles out of their cupped hands. So I'm not a huge fan of the tax structure under that. I'm not a huge fan of that tax structure. I think our tax structure needs to be a bit more equitable. It is both equitable and non-equitable here in the United States. The bottom 47% pays zero taxes. Between 43 and 47% pays zero federal taxes. It really, the vast majority of the burden, I'm not talking about taxes, the vast majority of burden of paying taxes lies on folks that make over $100,000 to up to $1 million a year, who are like W-2 employees. And there's actually plenty of them. I'm talking about doctors, lawyers, that sort of thing, who don't have a ton of write-offs, don't have a way to like hide income. Like, I own multiple businesses, and I'm always looking to open up a new business. I'm never sure how much money I earn by the end of the year, because a lot of the money that I earn goes out to start a new business or to fund a new business or something like that. And I get a tax deduction for that. A surgeon doesn't have that option, right? So a surgeon who makes $500,000 a year in the United States is probably paying somewhere like $121,000 total in taxes. I think the last time I saw it was like the guy made like 565 and he paid like $121,000 a year in taxes. Whereas a family of four that earns $60,000 a year in taxes in the United States pays zero in most states, because they get a deduction for property taxes, they get a deductions for state income tax, and they get the child tax credit, and they end up paying zero. So it's not fair. I think that family pays zero and they enjoy the benefits of being a citizen of the United States and all of our infrastructure. And that surgeon who might have two kids but doesn't qualify for earned income tax credits, doesn't qualify for child care tax credits, doesn't qualify and essentially all he gets is his standard deduction because he's a W-2 employee or something like that. Yes, he can afford it, but is he really entirely fair in that respect? I don't know. We need to do something with our tax code, and I'm not going to tell. I don't have all the answers, so I'm just pointing it out, though. Yeah, so that's one of the things that surprised me about UK politics is that they are returning to that Thatcherist idea of tax cuts for top earners. How are they going to cut taxes for top earners and support citizens with energy bills? They're also tightening policy by raising interest rates. But again, they're buying securities to prop up the market, which is counter to the monetary tightening policy that they have with raising interest rates. So it's very interesting what's going on. In fact, I heard that today that they were describing the monetary policy as being more like an emerging market. So, yeah. So good news about the market today. And I realized I haven't even looked at the last 30 minutes of the market, but the Dow or the Dow was down more than like 500 something points. The S&P was almost at 3,600, and the Nasdaq was down like 3.5% the last time I looked. But this is actually the good news. Okay, this is the good news, and let's talk about this. And I put this in the description. And a lot of people might not understand this. The more bearish asset managers are on the market, the more likely it is the market is going to turn around, right? And this is something that has been borne out over and over and over in markets. There's a lot of research going on behind this. We're going to talk about why it is, in this case, why it could be a good sign. I'll talk about why it might not be a good sign in the next article that we look at. But the latest American Association of Individual Investors shows that bearish sentiment in the week ending Wednesday, September 28th at 60.9%. First time in more than 1,800 weekly readings going back to 1997 that bearish sentiment topped 60% for 2 weeks running. Last week's bearish reading stood at 60.9%, but 2 weeks ago it was only at 46%. The percentage of bulls has stayed between 18 and 20% for the past 2 weeks, down from 26%, and the week ended in September 14th. What shifted more is the number of respondents who are neutral on stocks, 19.2% versus 27.9% on September 14th. Contrarians look at all that favorably, arguing that it means fewer sellers are left to push prices lower and the market's washed out, which means that we are close to market capitulation. In the latest Investors Intelligence Survey, this is a survey of basically professional financial advisors, also dated September 28th, the percentage of bullish financial newsletter editors has slumped to 25.4%, the lowest since early 2016, and below even the mid-June reading of 26.5% bulls that corresponded with a prior market low. So this survey is Investors Intelligence Survey has also been going on for a long time. Whenever it hits that level right around 27, 28%, that's generally a sign that the correction is over. that pessimism is reaching its nadir and the market is about to turn around. The problem is when it turns around this time, I think a lot of people aren't going to notice it. And we're going to talk about why. Funding flows are a little bit different right now. And I think that people are kind of paralyzed with indecision. Normally, in years past, if you were a stock market investor who was fearful that the stock market was going to crash, where would you go? You would go to bonds. We're in the midst of one of the worst bond markets, the worst bond market in history, at least since 1980 to 82. And where would you go to cash? Why would you go to cash when you're guaranteed to lose 8.9% annually on a cash position? Even if you put it into a CD, you're still guaranteed to lose money. Where would you go where at least you have the chance to make money? A lot of it, I think, is staying in the stock market. It's just that people aren't very happy about it, right? And I think instead of seeing a massive capitulation where all of a sudden all the sellers drop out, I think we're probably going to see them drop out rather gradually. And this article on from Fisher Investments, I believe, is a registered investment advisory firm. That I may not be certain on that. I know someone who works there though, who acts as a fiduciary. Meaning all of his relationships are fiduciary. That would generally be a sign that they're a registered investment advisory. But I haven't looked at the actual makeup of their firm. So, but yeah, and simply put, if you leave stocks, where would you go? Inflation looks set to eat cash alive. Gold is down far more than stocks since March. Commodities broadly are down too, because of course the anticipation of a recession and that commodity prices are going to go down. And after fears of war in Ukraine causing big shortages were overstated. Crashing crypto is hardly the stereotypical safe haven and that fearful stock investors would flee to. So we're talking about fear here. Fear is what's driving the market right now. Where are they going to go? Even the most traditional safe alternative bonds, those are down double digits since peaking in early January of 2021. We aren't saying these assets won't recover, and we happen to think that bonds decline is sentiment fueled and out of touch with the bond market's longer term supply and demand fundamentals. But fear arguably reigns there, making it an unattractive destination for people tempted to react emotionally to stocks declines. That's pretty much what I said there. All right. So lest you think our point is merely theoretical, we made some charts of stock and bond flows. Exhibit 1 shows weekly year-to-date flows for both, with U.S. stock and bond returns overlaid. As you'll see, investors have pulled much more money from bonds than stocks much more consistently this year. This isn't shocking when you consider how fund flows work. They tend to follow returns instead of anticipate them. Bond declines, though shallower than stocks, have been relatively steadier and lasted longer, seemingly leading to a steady stream of outflows. Stocks declines, by contrast, have been concentrated in short bursts, followed by seemingly fast rebounds, and flows have escalated at relative lows, but not to an astounding degree, right? So normally what would happen in this fear environment is that money would flow out of the stock market into the bond market, and you'd see a rebalancing in this case. What we're looking at, though, is flows aren't exactly behaving that way, right? As money is flowing out of the stock market here, it's also steadily coming out of the bond market as well. And we've seen fits and starts in the stock market here while the bond market has been in decline. I think that this puts a fine point on all of the arguments about market capitulation or where is the bottom. I think that the bottom is going to be a little bit harder to discern in this case, meaning we aren't going to see a sudden evaporation of sellers. We're going to see a gradual resignation of people to just stay in the stock market because there's nowhere else to go, right? Are you going to sit through, going back to this first thing, are you going to sit through 6 months of being down in order to be back up by 4% after 6 months? Or are you going to put your money in a CD where you're guaranteed to lose 4% over a year? Whereas you might be up on average, there's a 70% chance that you're going to be up on average 15% a year later. Yet that's your choice. Millions of people are going to make the choice, though, to go to cash, stick it in cash, lose money. They're going to make the choice to go to bonds, and then they might not lose much more money than they are now, but they're not going to have an opportunity to earn it back. I think that leaving it in the stock market, if you are sufficiently diversified, that's a big caveat, because a lot of people that I talk to are nowhere near sufficiently diversified. And there's a good chance that some of the stocks that you own will not come back from this. They had inflated valuations before and no pathway really to profitability. And remember, the most common return over the lifetime of any stock is 100% loss. 100% loss. Less than 1% of all stocks on the S&P 500 going back for the last 100 years have driven all of the returns for the S&P 500. That is a fact. That's a fact that was discovered in a paper which has the dumbest title on the planet. It's called "Do Treasuries Outperform Stocks?" Or it was either "Do Stocks Outperform Treasuries?" And he was talking about a 3-month Treasury, and he was talking. And this is a guy named Heinrich Bessenbinder who wrote this. I think it was from University of Arizona. It's some of the best stock research you can find out there that gives you the best argument for diversification in a really roundabout manner, though. Like when he points out that 1% of stocks in the S&P 500 over the last 100 years are responsible for basically 100% of the gain, he's not kidding. He roughly, out of the 26,000 stocks that were ever on the S&P 500, very few of them are even around today. Most of those companies have simply gone out of business. The average lifetime of any stock, it's only traded for 7 years before it's bought or it goes completely under. Or merges, and the most common return, and that's like saying, the most common return is 100% loss. So diversification is key here, especially in these markets. So Exhibit 2 shows that both of these, excuse me, I don't know why I always sneeze during live streams. Maybe I need to clean this room better. Exhibit 2 and 3 shows that both these recent fund flow trends are unusual. In past times of stress, fund flows have been deeply negative for a long time. See that huge cluster in 2020. For one example, and today's occasional outflows pale in comparison to those huge outflows we saw in 2020. But today's streak of bond outflows dwarfs anything in the short history of combined ETF and mutual fund outflows. The magnitude of outflows may have been bigger in 2020, but it was far shorter. Outflows today also exceed those that accompanied the fears of the Fed balance sheet runoff slamming bond markets in 2018 and the weird sentiment-fueled wiggle after 2016's presidential election. Yeah, that was really, really weird. It is a fact that the stock market performs better. I'm gonna lose subscribers over saying this, but this is a fact. You can just Google it right now. The stock market performs better when we have a Democratic president and performs poor when we have a Republican president. Neither one of those, no one being elected would actually make me get out of the stock market, because the president is not driving the stock market, but it is a fact. And in 2016, there were a lot of like weird things that were said that drove a lot of people out of the stock market for a brief period of time, and there were outflows right after the election, which I thought was kind of dumb. But yeah. So the longer history of bond flows here, which we go back to May 16, of course, we see this huge outflow of bond flows in 2020, which is anomalous. But we've seen this really since October of 2020. We can see a downward trend going all the way to April of 2022, and then another long outflow here. So we've seen outflows from bonds for a while. I think a lot of that went into the stock market. Now, though, since June of 2022, where are those outflows going? But they're much less pronounced, but it's a much longer duration than past events. So, So if people are broadly fleeing bond markets amid worldwide hand-wringing over rising rates, inflation, and the bear market in one global bond index, then fearful stock investors probably won't flock there. Investors inclined to capitulate to stocks decline, meaning investors that are just giving up on the stock market, don't seem likely to run to a market where people, maybe even the same people, are also capitulating. If you're driven by fear, it doesn't seem likely that you would exchange one scary asset for another. So where are these folks going to go? Are they going to go into cash where you're guaranteed to lose money? More likely, the lack of an attractive destination for fearful stock investors creates a sort of resigned paralysis, sighing and hanging on absent a better alternative. Perhaps that apathy is how deep pessimism towards stocks will manifest in investor behavior this time, defying those who avoid stocks because not enough people have sold yet. I think this is some of the best commentary, like short commentary that's a bit, that with illustrations of that I've seen in quite some time, stating that we may not see a traditional capitulation in the market where everyone gives up because everyone's just resigned to holding on because there's nowhere to go, right? Like I'm definitely not selling anything and going into cash. I'm definitely not buying any more bonds. I own almost no bonds. I have a very small holding in a junk bond portfolio. I'm sorry, those are called high yield bond portfolios now. I'm still stuck in the days when they were called junk bonds. So yeah. All right. Let me see here. Oh, good news also when it comes to supply chain. This is really good news. And actually, I heard something on NPR this morning as I was driving my kids to school or coming back from the gym. I'm not really sure, but I wanted to check this out. So this is actually from a few weeks ago, almost a month ago, actually. Only 8 ships waiting off of Southern California, but 41 off Savannah. So the that's actually gotten worse in terms of the East Coast. That now all of the supply backups are on the East Coast and they're not on the West Coast. In normal times at the port of Long Beach, port of LA, there's 0 to 1 ships anchored offshore waiting to offload their cargo. And that is true again. They're basically, there was a little bit of fear of the labor contract running out and possibly there being a strike at the ports in LA, Long Beach, and a couple of other places along the West Coast. That really didn't happen. Right now, West Coast ports are full, but there's no one waiting, right? And a lot of the deliveries have dropped off by quite a bit since last year, which is an indication that demand, along with this fear, of course, of a strike, but demand has also cooled off. A lot of what was going to the West Coast shipped to the East Coast, but in East Coast ports, it's nowhere near as bad as it was here, earlier this year and into last fall in terms of ships being backed up, right? And we look at the ship supply chain for the port of LA. Oh no. Here we go. Vessels in, it's right here. Vessels in Los Angeles Harbor. There are 11 ships at berth. Average time at berth is 4.8 days. Total planned vessels is 80, but this is the good thing here. So total vessels due inbound, 5. Average waiting time at berth, time of waiting at berth is 1.5 days, and vessels within 140 nautical miles, 0, meaning that the port is operating just normally at this point. So, and then, oh wow, you can even click to view the inbound vessels. They didn't have that a couple years ago when I used to use this site. So, but now you can see for yourself just what kind of backup there is coming from and these are all outside of 150 nautical miles at this point. So there we go. There's basically no one waiting in line at the port of LA, which is a really, really good sign. All right. Which it's a good sign for supply chain issues. So anyway, I am totally willing to open this up to comments on individual stocks if you guys wanted to talk about those today. I'm kind of done with talking about what I wanted to, but I'm going to go through and answer a few questions here. And so for some reason, my software is pushing through comments rather slowly. I'm getting them in bunches. So here we go. If China's economy suffers due to war in Ukraine, do you think Putin will listen? Personally, I thought the Chinese economy would have crashed due to Evergrande. So their government is quite a bit more interventionist in their economy. And so I don't think the events that would have precipitated a crash here, and we're talking about Lehman Brothers and Bear Stearns, those are the companies that would not have been allowed to go out of business in China. They would have been backstopped. Of course, their CEOs would not have been put in prison. They would have been executed or something like that. Literally would have been executed or something like that. But that wouldn't happen. They're far more interventionist, especially when it comes to monetary policy. So let me see here. Want to ask any more? Maybe tomorrow, but taking too much time. Thank you. Actually, I just like questions, period. I'm going to answer as many as I can. But the Chinese economy probably has not suffered really from Ukraine. I think that they probably worked out some pretty good deals for Russian oil. So China can absolutely, they don't have any of their own domestic oil supplies. Well, they do, but it's very little. They don't have some of the best oil properties and deals worked out with companies outside of China as well. And so they're always in search for a good oil. I don't think it was ever the plan to have China on board with sanctions on Russian oil. I think that realistically we knew that that wasn't going to happen. But I also think that we knew that the Chinese were going to make the Russians pay for that partnership without limits. And that's one of the things that I thought was fairly interesting, is that the rest of the world kind of pretended like it was worldwide sanctions on Russian oil. I think the only surprise was India. India, of course, is in the same boat. They really can't afford to. They really can't afford to have sanctions on Russian oil, but they're making Russia pay the price, and I think that's very interesting. So, did you see the unemployment report today? So unemployment was below, only had 193,000 applications for unemployment. I think the economists are expecting 218,000. Usually, to me, that number is statistically insignificant. The difference between 193,000 and 218,000, when the numbers get that low, is statistically insignificant. But if your employer does not match inflation, go look for another job. There are jobs out there. There are plenty of jobs out there at this point. If you're worried about being laid off, and you're worried about, and if you have a lot of seniority in your company, maybe that's not a great idea. But if you are a young person, and this is how your parents kept up with inflation in the 1970s, is that when it came time to ask for a raise, if your employer didn't give you a raise, you could go find another job. And wage inflation was one of the primary things back then that was actually forcing inflation as well. That's one of the things that's forcing inflation here now. We have this brief period right now where labor has a lot of power. And if your employer doesn't match inflation, at least match inflation, I would be looking for a new employer at this point. This is how your parents experienced that inflation-induced debt destruction in the 1970s. All these boomers that are sitting on, they're like, well, I had my house paid off by 30. Yeah, it's because you experienced double-digit inflation for like a 5-year period, right? And your income kept up with it. So, and that's why you could buy a house for $20,000 in 1968, and by 1988, it was worth $500,000. That's inflation, my friend. That happened all over the United States, especially all over, really expensive areas like California. And I literally know people in Southern California that bought their house in, 1974 for like $22,000, and then sold it for $500,000 in the early 2000s, and they thought they were geniuses. And they made fun of people that couldn't afford a home, right? And said, I bought my first home when I was 22. Like, your home was $22,000, and you made $18,000 a year, right? That's a huge difference. Like, you're not huge difference. So, Michael Will says, this is my opinion. No need to comment. Liz Truss is a puppet. She was put in her position by the old guard so that she could manipulate to deliver their policies, or they could just withdraw support. Okay, awesome. I don't, like I said, I don't really comment on the politics of foreign democracies. Give me a good old fashioned autocracy, and I'll comment all day long, because they are not legitimate rulers. Yep. So Moneyline is down 30%. Yeah, I did actually buy some more Moneyline shares today. Like I said, my acquisition cost is super, super low. It's about $1.60 right now, which means I'm down a lot, and I've got like 14,000 something shares right now. I'm probably going to stop buying. It's basically, at this point, I'm gambling right now rather than investing. So I'm going to stop buying Moneyline at this point. But I'm going to hold Moneyline. At this point, there's no reason not to hold it until it either goes completely under, but my basic time horizon for Moneyline right now is 5 years. I think that even with apart from this lawsuit and the lawsuit will be settled out of court. This is what happens is, the Consumer Protection Bureau, or whatever it was, that filed a lawsuit against them. They issue a couple of statements saying, no, it's not true. But instead of going to court, they're going to settle out of court for a couple of $1 million. That's going to affect the bottom line a little bit for Moneyline. It may end up changing some of their policies. I don't know how much that sort of membership policy for that lending club that they have actually drives revenue. There's other things in there that on their app that are driving revenue. But so I think that the odds that the stock rises from 80 cents are pretty good. I think that the odds rising past $1.60, which is my cost or so in the next 5 years, So long as there's not a bankruptcy, I think that it's pretty good, especially because they're looking at being EBITDA break even by the end of the year, meaning earnings before taxes, depreciation depreciation, amortization. That's all going to be cash flow neutral by the end of the year, supposedly. And even if it isn't completely neutral and they come pretty close to that, I'll be happy. It may actually cause the stock to go down a little bit more, but I'm not going to purchase anymore. I have enough. 14,000 shares is enough. And that's basically kind of what I did with NEO as well. I ended up buying NEO at like $1.80 a share and sitting on it for a couple of years. But yeah, I'm almost out of NEO at this point, based on options. My last couple hundred shares that I have, the options that I sold on that will likely expire, and I'll have to sell options again on it. But yeah. Anyway, questions. Let me see here. Is there any serious reason for NEO to get down this bad, 10%? So yes and no. You have to look at NEO in the context of its domestic competition. And Hamdan, what you may not realize if you don't really study the Chinese market is that NEO is just not that big of a company, and they face a lot of competition from a lot of really innovative people. And the only reason that we've heard about them is because they went public with an ADR on U.S. markets here, and they've gotten a lot of press here. But they're not the most important. They're not the most impressive. They don't hold the most market share. They're not the fastest growing. They don't have the best technology, right? They're a good company. Don't get me wrong. Just like Xpeng is. Xpeng isn't the biggest. It's not the best. They don't have the best technology. They're not the fastest growing. They don't have the best vehicles. They don't have the most impressive vehicles. They've gotten a lot of press here. What I do like is their plan for actually building, right? This is what I really like about Xpeng is their plan for building and their willingness to adopt ideas from companies that are doing this successfully. But yeah, so is there a reason for NEO to get this bad? Was there ever a reason for NEO to be that high? That's the real question we should be asking. And so I ended up, let's see. So most of my shares I bought at about $1.80, but I ended up buying like another 100 shares at like $44 or something like that. And of course, I did not bail out of those in time. I ended up, hold on, I got to turn off my phone again. It's always ringing this time of day. Sorry, that is actually my lawyer calling. I'll have to call her back afterwards. So a lot of folks would think that the delisting concerns were completely off the table at this point, and that is actually not true. The mechanics of how everything is going to be delivered to the U.S. have still not been worked out, but the negotiations were always going on behind the scenes in good faith. And it was never like a contentious process. It's professional bureaucrats talking to professional bureaucrats. There was always something on the table. I actually expected them to wait till the last minute. They didn't do so, and so I think it'll be worked out in time. So there's less concern than there was before, but it's still a concern, but a lot less concern. I'm not sure yet, and I'll probably watch. I won't watch it live, but I'll probably watch the recording of it. I think I'm going to go surf tomorrow morning. I need to take a step away from the markets too. So, just curious, what is happening with crypto? They seem to track the rest of the market instead of being a hedge. So, yeah, it's not a hedge against the market. And that's of course what people thought it might be. But if you think about it, there was never a good reason to believe that cryptocurrency would be a hedge against the stock market, for a couple of different reasons. Number one, the old idea of hedges is a bit antiquated at this point. All asset classes have begun to become more correlated as markets have become more democratized, as more and more people have gotten into trading and markets and things like that. The old barriers of correlation have been broken down, and all assets tend to be more closely correlated than they were before. But what was the reason to believe that cryptocurrency would to be a hedge against the market? It's a hedge in general in a portfolio, meaning it should have its own behavior unrelated to the bond market, unrelated to the stock market, but not necessarily a hedge against one. Like stocks are generally a hedge against bonds. Bonds are generally a hedge against stocks. There's never a reason to believe that, even though almost everyone did. the big hedge that everyone thought it would be against inflation because of the limited issue of coins. But when you allow the coins to be endlessly fractionalized, that's one thing that works against hedging. But the other thing is that the market is just really immature right now, and it's only 11 years old at this point. And to say that any market or asset class, and I hesitate to even call it an asset class, can be considered a hedge is kind of strange. And the whole idea of cryptocurrency in consideration apart from blockchain, I think, is a giant mistake. I think that the blockchain that ends up winning the most amount of transaction volume is the one that is going to have the greatest increase in tokenomics. Although, look, there's also not a direct correlation between that. What just because Ethereum uses because the endless way to fractionalize coins, just because there's more transactions on the Ethereum network than any other network on the planet, how does that mean that the coin is going to be worth more when you can endlessly fractionalize? There's not a good explanation for that. I think that crypto token economics is going to take longer than 11 years to understand. And all of these people with trading strategies and all of these people, they're just bullshit. Oops, crap. I should have said that online. Now that's going to be a delay between monetizing the video. Anyway, I got a warning not a warning, but like I got one of my recent videos, they delayed monetization on it because I said the S word on it. So it took like a couple hours to be monetized. All the views come in the first couple of hours. So yeah, it kind of hurt that. But anyway, that's kind of my explanation for that, is that the market is just really immature and we don't know what's going to happen with it. And out of the 19,000 cryptocurrencies right now, 18,990 of those are probably crap and are going to end up being worthless. And only a few of them are going to survive. It's going to be worse than the Christmas Day, massacre. It's going to be just a giant massacre. There's going to be trillions of dollars in wealth just that evaporates. Which, oddly enough, I don't think it's going to happen soon enough to affect inflation, but possibly it could. And yeah. So anyway, folks, we're coming up on an hour here. I'm going to give you guys one more minute or so to get some questions in. If you have any questions, then I'll go ahead and stick around. But if not, I'm going to go ahead and hop off for the day. I got a few things to take care of before I go train some more. And yeah. All right. No more questions. So it looks like I'm getting off for today. Thank you guys very much for attending. This is a really good live stream in terms of the information that I covered. I hope you guys found it helpful and hopeful what I talked about today. And like I said, I am already looking forward to the new beginning of the next bull market. I've written this credit cycle off, essentially. I am not going to be a hero. I am not going to fight the Fed. I am keeping some powder dry. I'm making investments now rather than selling off. It doesn't matter to me if there's another leg down in the stock market, there's another crash. We go back to this right here. 6 months from now, 60% chance we're going to be in positive territory. A year from now, 70% chance we're in positive territory. 3 years from now, 89% chance we are in positive territory. All right. Thank you very much, guys. I hope you liked that little positive message today, and I will see you next time.